If you're like most Americans, you're probably still feeling the pain at the gas pump, but not just because of that, it's because you're also feeling the pain when you go to the grocery store. You fill up your grocery cart with all the same groceries that you normally get, but it's costing you a lot more than it did last month and the month before and the month before that, and it's been about 1.5 to 2 years now of continuous price increases in all the stuff that everybody needs to buy. However, the dollar has been getting a lot stronger. Over the past year, it has gone up about 24%. This means that compared to other currencies, the United States dollar is doing extremely well. And on top of that, the fact that we import $3.4 trillion worth of stuff from other countries, leaving us with a deficit of $676 billion, we are currently exporting a lot of our inflation to other countries. And it is only a matter of time before this results in a sovereign debt crisis. Ready? Let's dive in. Take a look with me here at this chart of the US dollar. This is DXY. The DXY, this is the dollar versus a basket of other currencies. And just to highlight here, I've drawn this red line, which shows that since May of last year, so just over a year, the dollar is up almost 24%. Massive rally that we've seen here. What you'll also notice as we just scroll back here through time, keep on going, and finally we get to an area where the dollar was at the same level where it's at today. You'll notice it only lasted about 2 years here, and it did not reach that level again until today, and it wasn't up at that level before that until we get all the way back to the 80s. If we zoom out and look at a monthly chart here, as though we can see all the way back to the 70s, we can see that the dollar rarely gets up to levels this high, and when it does, it quickly comes crashing back down to these lower levels. Now, given the fact that asset prices have been collapsing, yet goods and services have been increasing in cost, many people are wondering what to do with their money, because if you put it in dollars, you're just losing to inflation. But if you keep it in assets, you're losing because the price of those assets are falling. That's one of the reasons why I created my portfolio allocation mastery course. Link is in the description below to teach you how to avoid being vulnerable to crises like this. But with the dollar going up, we can only imagine the havoc that is being caused for people in other countries that need to get their hands on dollars. So why would people in other countries need to get their hands on dollars? Well, the first reason is because of our trade deficit. If we look at the United States trade deficit, we can see that we imported last year, 2021, $3.4 trillion worth of goods and services. That is a massive amount of money, dollars, that we are sending overseas to countries all around the world that are taking dollars for real stuff. They're doing this because the dollar is the global reserve currency. Now, we also sell a bunch of stuff to other countries, but not as much as we buy from them, leaving us with a trade deficit of $676 billion. That means last year we exported $676 billion to the rest of the world, and in exchange for that, on net, we got some of their stuff. Now, keep in mind, trade deficit, this is different than a budget deficit. A budget deficit is where the government taxes money and then spends money, but they spent more than they taxed, so they have to borrow the difference. This is separate. This is a trade deficit, talks about how much stuff we buy and or sell from other countries around the world. Now, because these times are uncertain, to say the least, economically speaking, many countries need to get their hands on dollars because this is a flight to safety. And many countries, when they need to access capital, they cannot borrow in their own currencies. This article from worldbank.org points out the poorest countries cannot borrow in their own currency because lenders are unwilling to assume the risk of being paid back in those borrowers' volatile currencies. So they have to borrow dollars, they repay their debts in dollars, no matter what the exchange rate is. This means that as the dollar gets stronger in between the time that they borrowed it and have to repay it, they're going to eventually need more of their own units of currency to exchange for dollars just to pay that debt back, which causes a spiral, a positive feedback loop that depreciates the local currency and makes the dollar appreciate even more as this phenomenon continues. This has caused many currencies to weaken severely against the dollar over the last year or so. If we take a look at this chart, we can see the biggest one on this chart at least is the Sri Lankan rupee, but many countries, including Chinese yuan and the Indian rupee and the Chilean peso, have all depreciated versus the dollar, and very few of them have actually appreciated. Now, if you'll notice here on this chart, sneaky of them, they left off the Russian ruble. You can see it's nowhere to be seen. So since they won't show you Russian currency versus the dollar, I will. At the start of this year, the ruble was right around here. We had a quick fall when the invasion started, and it's popped and sustained since then, looking suspiciously a lot like the price of oil. Putting this all together means that as the Federal Reserve continues to tighten, sells assets off its balance sheet, raises interest rates, that means that dollars become more scarce. That is the net result of tightening. It's harder to get your hands on dollars. Now, they're doing this because of inflation back here at home, because if they don't, they risk hyperinflation. They don't want to risk that. And so they're tightening in order to avoid this. But what that does is it causes the dollar to get stronger versus other currencies, because other currencies are in countries that are weaker economically than the States, and they are not tightening as fast as the Fed is tightening for the dollar. The problem with these countries is that they still need dollars, and so their currencies are weakening while the dollar is strengthening. Meanwhile, they still have to get their hands on dollars. This means that as bad as inflation has been in the States over the last year or so, a lot of that inflation is being exported forcefully into other countries, emerging markets that are highly leveraged with weakening currencies, and they are on the verge of experiencing a sovereign debt crisis. Now, I've said this before and I'll say it a million more times. The only thing that gives you the ability to abuse your position of power is a monopoly on that power. So when you have a monopoly on the global reserve currency, you have the ability to abuse that power. However, the more you abuse a power, the faster you lose that power. And the more the United States imposes economic pain on the rest of the world from bad financial decisions, the faster the rest of the world will find a reason to move away from the dollar, get fed up with it, and start to look for other currencies that are more stable, stronger, and better for them. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.